If you are tuning in right now, there is a very good chance that you have felt that highly specific, agonizing frustration of watching a portfolio just bleed out in real time.
Oh, absolutely. It is a very specific kind of pain.
Right. Like you know the exact feeling. You hold a major tech stock, maybe one that everyone hailed as the absolute undisputed future of humanity, and suddenly, bam, you are just getting battered by cyclical headwinds.
Yeah, and the headlines do not help.
They make it worse. You're watching these brutal price wars play out, and you are waking up to financial news screaming that the entire growth story is dead.
Which is exactly what we are seeing right now.
Nowhere is this pain more acute right now than with Tesla. I mean, let's just look at the cold, hard reality of their 2025 data. Auto deliveries actually fell by 8%.
5%, yeah.
Automotive revenue dropped. The entire mainstream financial media is in a state of absolute unmitigated panic. We have been sold this massive hype around robotaxis and full self-driving for years.
For a decade, really.
Exactly, for a decade. And yet, looking at this 2025 data, those promises have just not saved the stock.
No, they haven't.
The dominant narrative right now, the one you see on every single major financial network every single morning, is that this company is just another struggling automaker caught in a brutal EV demand slump.
Which, on the surface, makes sense.
It does make sense, honestly. Looking at the billions sunk into gigafactories worldwide and the identity of the company being so tied to the cars, it is really hard to argue with Wall Street's panic.
It is entirely logical to panic if you're only looking at the assembly line.
Right.
But that is the perspective we are going to tear down today. Wall Street is judging this company through a completely fractured lens. They are obsessively staring at the car factory, tracking every single vehicle that rolls off the line in Texas or Shanghai.
Because that's what they've always done.
Exactly. While the smart money, the institutional players who are actually positioning their capital for the next decade, they are looking at the power factory.
The power factory.
Okay? Yes. The mission for our deep dive today is to step entirely away from that mainstream panic. We are going to uncover a deeply undervalued hidden cash flow engine operating inside this mega-cap company well before the broader market prices it in.
Which is what we love to do here.
It is. And to you, the listener, you might be wondering why you should even dedicate your time to this if you aren't actively trading stocks or managing a massive portfolio.
Fair question.
The reason is that this isn't just about a car company anymore. It's about the physical infrastructure of the global artificial intelligence revolution.
That is a massive claim.
It is, but you are about to see how a monumental global shift is hiding right in plain sight, completely obscured by these panicky headlines about consumer car sales.
Look, I am willing to go down this rabbit hole with you, but I have to play the skeptic here. Wall Street analysts are entirely foolish.
Not always, no.
There is a reason they focus on the cars. Automotive sales have historically been the overwhelming majority of this company's revenue.
Historically, yes.
They have spent the last decade building massive manufacturing footprints solely dedicated to bending metal. You can't just wave away an 8% drop in auto deliveries as a mere distraction.
I'm not waving it away.
But the mainstream media doesn't invent a panic out of thin air when a company misses targets by that magnitude. You are going to have to bring some incredibly rigorous evidence to convince me that the baseline narrative is wrong.
I will bring the data. Today, we are opening a forensic macro analysis and equity valuation file on what we are calling the Energy Moat.
The Energy Moat?
Yes. I'm going to lay out 5 specific forensic numbers from their 2025 data that definitively prove the car company narrative is a relic of the past.
Okay, let's hear them.
But to understand why these numbers are so shocking and why Wall Street is so blind to them, we first have to examine the historical context of how this company was priced to begin with.
Which was basically perfection.
Exactly. Since the very beginning, Tesla was never priced as a traditional metal-bending automaker. If they were, their valuation would have mirrored Ford or Toyota.
Right, they would have a low PE ratio.
Precisely. Instead, the market priced them as a revolutionary tech company, expecting massive, software-like margins on every single car sold.
Which makes sense based on the promises that were made to us. The thesis was always that the hardware, the physical car itself, was basically just a vessel, a Trojan horse to get a computer into your driveway so they could sell you high-margin software subscriptions for autonomy.
And that exact promise is what created the setup for the current panic. Investors bought purely into the hype of robotaxis, flawless autonomy, and absolute software perfection.
Right.
When you price a company for absolute automotive tech perfection, you create an incredibly fragile valuation model.
It's a house of cards.
It is. Think about it from an analyst's perspective. Their spreadsheets assumed millions of cars sold every year with 80 or 90% margins on the software side.
So any slowdown.
Any cyclical dip in consumer spending, any delay in that software perfection, breaks the math. And the market brutally punishes broken math. That is what happened when the 2025 auto deliveries fell.
Yeah, because pricing for perfection means there is zero margin for reality. If your entire market cap is justified by an assumption of uninterrupted exponential growth, an 8% drop in physical deliveries isn't just a quarterly miss.
No, it's a disaster.
It shatters the foundational thesis of your entire valuation. It completely invalidates the spreadsheet. So the market reacted the way any highly leveraged, fragile system reacts to a shark. It broke.
It broke the old narrative. But while the market was entirely distracted by the slowing EV sales, the delayed autonomy promises, and the CEO's extracurricular activities,
Which there are plenty of.
a secondary division quietly woke up and became a behemoth. This is the Energy Moat.
Okay, I'm listening.
If you want a visual metaphor for what is happening right now under the hood of this company, I want you to imagine something.
Go for it.
Imagine a crushed, alert red electric vehicle sinking into heavy shadows in the background. It's battered, it's struggling, it's fading into the dark.
Okay, dramatic.
Now, imagine in the extreme foreground, looming massively, a towering, sleek industrial battery unit, a Megapack. It is glowing with an intense electric cyan light, radiating power. That is the new reality. That is the hidden giant.
The imagery is potent. The red car fading into the shadows while the cyan battery takes over the foreground. It completely flips the script.
That's what the data shows.
But imagery doesn't pay dividends, right? It doesn't build a balance sheet. I will concede that auto sales are struggling, and I know battery storage is a growing sector, broadly speaking. But I need to see the hard data.
Yeah, I get it.
Because it's one thing to say they have an energy division. It is another thing entirely to prove that these batteries can actually replace the billions of dollars in lost growth from the automotive side. Give me the forensic numbers.
Let's get right into the first two numbers, which represent what I call the deployment shock.
Deployment shock.
Yes. For most of its life, the energy division felt like an expensive side project. It was the thing they talked about at the very end of the earnings call. But in 2025, it became the main event.
All right.
The first forensic number we need to analyze is 46.7 gigawatt hours.
Let's pause right there, because 46.7 gigawatt hours is a completely abstract number to most people.
It is a massive number.
But if we don't put that into perspective for the listener, it just sounds like technical jargon. What does that actually look like in the physical world?
That's fair. To give you a sense of scale, a single gigawatt hour is enough energy to power roughly 1 million homes for an hour.
1 million homes.
Yeah.
For 1 hour.
Yes. And we are talking about deploying nearly 47 times that amount of energy storage capacity in a single year.
That is insane.
These are massive shipping container-sized batteries called Megapacks alongside the residential Powerwalls. That 46.7 gigawatt hours represents a colossal 49% jump from the previous year.
49%.
I want you to hold those two trajectories in your head and weigh them against each other. The car deliveries, the thing everyone is hyperventilating about, fell by 8%.
Right.
Meanwhile, the physical deployment of massive grid-scale batteries shot up by nearly 50%.
A 50% jump in physical infrastructure deployment in a 12-month window. That is staggering for industrial hardware.
It's unheard of at that scale.
We aren't talking about pushing a software update over the air to millions of phones. We are talking about mining raw materials, manufacturing massive metal structures, filling them with complex chemistry, shipping them on freight vessels globally.
Pouring concrete pads at utility sites.
Exactly, wiring them into the high-voltage grid. Doing all of that and increasing the volume by 50% in 1 year is a monumental logistical feat.
It is, and it brings us directly to the reason why this demand is exploding so violently right now. It is the artificial intelligence boom.
Ah, AI, of course.
We hear about AI constantly in the context of software, right?
Yeah.
Chatbots, image generators, coding assistants. But we rarely talk about the physical reality of AI.
The hardware side.
Yes. Artificial intelligence is a thermodynamic beast. It requires immense, unfathomable amounts of power to train and run these massive language models.
Let's dig into the physics of that for a second, because I think a lot of people just assume the cloud is an ethereal thing.
It's not.
It's not. The cloud is just a massive building full of incredibly hot computers. When you are training a frontier AI model, you have tens of thousands of GPUs running at maximum capacity simultaneously.
They generate massive heat.
They generate so much heat that data centers require millions of gallons of water just to cool them down, and the electrical draw from the local power grid is astronomical.
Exactly.
We are talking about single data centers requiring the same amount of electricity as a mid-sized city. The standard legacy power grid simply cannot handle that kind of localized, intense draw. It literally causes brownouts.
Precisely. The grid architecture we rely on was built for a completely different era. It cannot handle the sudden, massive surges in demand from AI data centers.
No way.
Nor can it efficiently integrate intermittent renewable energy like solar and wind. Tesla isn't just making batteries to keep your refrigerator running during a thunderstorm.
Which is what everyone thinks of when they hear home battery.
Right. But at the macro level, they are building the critical grid stabilizers that make the global AI revolution physically possible. They are the shock absorbers for the global power grid.
The shock absorbers.
Yes. Without massive energy storage solutions buffering the draw, the AI data centers cannot expand. Tesla is the physical bottleneck.
So when retail investors and institutional funds are out there aggressively buying up semiconductor stocks or pure play software companies to ride the AI wave, they are completely missing a foundational layer.
They are missing the floor it all stands on.
None of those chips and none of that software functions without the power grid infrastructure to support it.
That is the blind spot. Now, let's look at the second forensic number to see how this translates to the income statement. $12.8 billion in revenue.
$12.8 billion.
That massive 46.7 gigawatt-hour deployment translated to nearly $13 billion in energy revenue for the year. That is a 27% year-over-year increase. The energy division now makes up 13% of the company's total overall revenue.
Okay, I'm looking at this data, and my skeptic alarm is absolutely blaring right now.
I thought it might.
Let's look closely at the two numbers you just gave me. You said deployments, the actual physical volume of batteries shipped and installed, grew by 49%.
Yes.
But the revenue generated from those deployments only grew by 27%. If I am an investor or a Wall Street analyst analyzing this company, that divergence is a massive red flag.
Is it?
Absolutely. Doesn't that mean the revenue isn't keeping pace with the manufacturing volume? Doesn't that heavily suggest they are losing pricing power?
That's the standard read.
It looks like they're having to slash the prices of their megapacks just to induce demand and move the product.
That is exactly the surface-level conclusion that a junior analyst at a legacy bank would put in a memo. It seems like a margin-crushing dynamic.
Because in any other industry, it is.
But this raises a much deeper strategic question. What if falling prices aren't a sign of market weakness, but a deliberate weapon? We call this strategy the weaponization of price. The decrease in revenue growth relative to the physical deployment growth isn't an accident, and it isn't a failure of sales. It is a highly calculated, aggressive strategy. Tesla is intentionally driving down the cost per kilowatt hour of their batteries.
I have a hard time believing any public company intentionally chooses to make less top-line revenue per unit just for the sake of it.
They don't do it for the sake of it.
Why would you deliberately cannibalize your own revenue growth in a market where you are allegedly the bottleneck? If everyone desperately needs your batteries for AI data centers, shouldn't you be raising prices to capture that premium?
You raise prices if you want a great quarter. You drop prices if you want a global monopoly.
Oh, wow.
They are choosing to ruthlessly squeeze out weaker competitors and capture overwhelming market share. Think about the legacy industrial giants like Siemens or GE, or the myriad of heavily funded green tech startups trying to enter the utility-scale battery space.
There are dozens of them.
Exactly. If Tesla continuously drops the price of a megapack, while simultaneously scaling their manufacturing footprint to levels nobody else can possibly match, they systematically starve their competitors of the profit margins needed to survive.
So they are bleeding out the competition.
A startup cannot compete on price against a company manufacturing at that scale. Tesla is playing a multi-decade game. They are prioritizing the establishment of an unbreakable global monopoly over short-term, quarter-by-quarter revenue spikes.
If you trace the lineage of that thought, it fundamentally alters the entire investment thesis. What you are saying is that they are treating energy storage not as a premium luxury consumer good, but as a base layer utility.
That's it exactly.
They are moving away from selling highly cyclical consumer-dependent goods, like a shiny new $70,000 electric car that a family might put off buying if interest rates go up or if consumer confidence dips.
Which is exactly what we saw in 2025.
Right. And they are moving to selling core global infrastructure. They are actively trying to decouple the survival of the company from the unpredictable whims of the consumer auto market.
That decoupling is the masterstroke. When macroeconomic conditions tighten and interest rates rise, a middle-class consumer might decide to keep their gas car for another 3 years. That hurts auto sales immediately.
Of course.
But a massive utility company or a trillion-dollar tech giant building a billion-dollar AI data center cannot wait 3 years. They have government mandates to meet or AI training schedules to maintain.
The AI race stops for no one.
Exactly. They need grid stabilization right now, regardless of whether consumer sentiment is high or low. By shifting their weight toward this energy mode, Tesla is transitioning into a fundamentally different, far more resilient type of business.
The strategic vision is brilliant, I will grant you that. $13 billion is a massive amount of revenue, and decoupling from the consumer market is the holy grail for a manufacturing company.
It is.
But, and this is the biggest but in industrial economics, revenue absolutely does not equal profit.
It certainly does not.
You can sell $20 billion worth of heavy equipment, capture all the market share in the world, and still go bankrupt if your internal costs are too high. Building giant, chemically complex batteries is an incredibly capital-intensive business. I refuse to declare this a hidden giant until we look at the margins.
I am thrilled you brought up margins because this is where the entire mainstream media narrative completely fractures. This is the absolute aha moment of this deep dive. Let's move to the third and fourth forensic numbers, representing what we call the margin flip.
The margin flip. Okay, lay it on me.
The third forensic number is their gross margin on the energy division, 30%.
Wait, I have to stop you. 30%.
30%.
Are you sure that's the gross margin on the heavy industrial battery division and not a typo from their software division?
It is not a typo. 30% gross margin on the energy division.
I'm going to push back incredibly hard on that figure. The accepted wisdom on Wall Street for decades is that large-scale battery storage is a low-margin, capital-heavy, miserable slog.
Which was true for a long time.
It's supposed to be a pure commodity business. You mine the lithium, you build a massive metal box, you sell it to a utility company, and you scrape by on a 5, maybe 6% margin if you were lucky.
If you're lucky.
30% is a software as a service margin. You simply do not get a 30% margin on a heavy industrial manufactured box without some sort of accounting gymnastics. Are they padding that number with regulatory carbon credits? Are they just temporarily benefiting from crashing lithium spot prices on the global commodities market? How is 30% physically possible?
Your skepticism is exactly why Wall Street missed it. They share your exact assumptions. But the old narrative is dead. The 30% margin is real.
Explain the math.
It is achieved through a combination of extreme vertical integration, manufacturing scale that no one else possesses, and a highly misunderstood software overlay.
A software overlay.
Yes. They aren't just selling a dumb metal box full of lithium. Every Megapack is integrated with a proprietary software platform called AutoBidder.
AutoBidder. I've heard of that, but what does it actually do?
It autonomously trades energy on the grid in real time. The utility companies aren't just buying hardware. They are buying an AI-driven energy trading system that pays for itself.
Right. Really?
Yes. It buys energy when it's cheap, stores it, and sells it back to the grid when demand spikes. That software integration commands a massive premium. And when combined with their ruthless cost-cutting on the manufacturing floor, you achieve a 30% gross margin.
That software layer changes the entire calculation. It's not a battery. It's a high-frequency trading algorithm wrapped in lithium.
Exactly. Now, I want to force you to compare these numbers, because this is the absolute crux of the market mispricing. Think about their automotive gross margin. The single metric that Wall Street analysts spend 24 hours a day sweating over.
Right, the thing everyone is panicking about.
In 2025, that auto margin was hovering around 17%. And falling due to price cuts.
17%.
Yes. And the energy division is at 30% and rising.
Let me state that plainly so it really sinks in for the listener. For every single dollar of revenue brought in the door, the relatively obscure energy business is generating nearly twice as much profit as the famous, highly publicized car business.
Which brings us to the fourth forensic number. $3.8 billion in gross profit.
3.8 billion.
Yes. That 30% margin translates to nearly $4 billion in pure gross profit flowing directly onto the company's balance sheet from the energy side alone. That represents a 44% increase in gross profit from the previous year.
This is the forensic leverage you were hinting at earlier. Let's do the math in real time to see the distortion here. You stated that the energy division accounts for roughly 13% of the company's total revenue.
Correct. A fraction of the whole.
But if they are generating nearly $4 billion in gross profit at a 30% margin, while the massive bloated auto division is struggling to maintain 17%, what percentage of the total company's overall gross profit is this 13% side project actually generating?
It now contributes nearly a quarter. 25% of the company's total gross profit is generated by the energy division.
That is insane operational leverage. 13% of the revenue is carrying 25% of the profit.
It's doing the heavy lifting.
Let's go back to your visual metaphor for a second. Imagine that sleek, towering cyan megapack installed at a dusty utility site somewhere in Texas. A massive, heavy industrial cable is plugged into the side of it. But instead of invisible electricity flowing out to the grid, imagine a relentless, heavy waterfall of glowing gold coins pouring out of the exhaust vent directly into Tesla's corporate treasury. It is the ultimate quiet cash cow.
It is the perfect visual. And yet, if you turn on the major financial news networks tomorrow morning or read the prominent analyst notes, what will the primary topic of conversation be?
They will be talking about the 8% drop in car deliveries in China. They will be obsessing over shrinking automotive margins, writing breathless panic headlines, and overanalyzing every single social media post from the CEO about a delayed Robotaxi prototype.
Exactly.
To you listening right now, I want you to internalize this dynamic. Wall Street is completely ignoring a hyper-profitable cash cow scaling massively behind the scenes because they are structurally biased to look at the cars. How often do we, as investors or just consumers of news, judge a book entirely by its cover instead of reading its balance sheet? The market is scrutinizing the aerodynamic shape of the car and completely missing the vault of cash sitting in the trunk.
It is the textbook definition of a deep market inefficiency. The smart money, the hedge funds, and institutional buyers who truly do the forensic math, they love when a secondary division hits these kinds of numbers quietly.
Oh, they feast on it.
They really do. It gives them a window of time to accumulate shares and build their positions, while the retail market and the talking heads are distracted by the noise.
You have completely convinced me that the profitability is real and the leverage is undeniable. The math of a 30% margin yielding $4 billion in gross profit is ironclad. But this revelation raises a completely new, massive concern for me as a skeptic.
Okay, let's hear it.
They have this incredible gusher of cash. What on earth are they actually doing with it? Because the other dominant headline you see constantly is that the CEO is burning billions of dollars on futuristic sci-fi projects that may never see commercial viability.
This is a crucial pivot, and it leads us into the fourth section of our analysis, bankrolling the moonshots. You are absolutely right that Tesla plans to spend a staggering amount of capital. Specifically, they have guided for over $20 billion in capital expenditures, or CapEx, in 2026 alone.
$20 billion in CapEx in a single 12-month period. That is a GDP-level expenditure. Where exactly is that money going, if not into building more car factories?
A massive portion of it is being routed directly to fund artificial intelligence computing clusters, advanced robotics research, and specifically the Optimus humanoid robot program.
And this is exactly what the media attacks them for. They write these massive, scathing hit pieces claiming that the leadership is recklessly burning cash on sci-fi vanity moonshots while their core car business actively declines. They paint the robotics program as a distraction that is going to ultimately bankrupt the company or severely dilute shareholders.
But those hit pieces fundamentally misunderstand the mechanical reality of the balance sheet. They're hyper-focused on the $20 billion in spending, but they aren't looking at where the internal funding is actually coming from.
The battery money.
Exactly. The reality is that the massive, steady, highly predictable profits from selling Megapacks to utility companies, that $3.8 billion gross profit engine, are exactly what is bankrolling these futuristic AI bets.
So to be clear, they are not going to the bond market and borrowing money at high interest rates to fund the humanoid robots. They aren't issuing millions of new shares and diluting existing shareholders to buy massive GPU clusters for AI training. They are organically using the cash generated by the relatively boring, highly profitable industrial business of grid stabilization.
Precisely. The energy division acts as a massive financial shock absorber for the entire enterprise. It fundamentally de-risks the company's most ambitious projects.
That's a huge point.
Think about it. Even if the consumer auto market stays depressed for the next 3 years due to high interest rates, and even if the Optimus robot takes an entire decade to reach true mass commercialization, the company possesses an internal, self-sustaining funding mechanism that operates entirely independently of consumer sentiment.
That changes everything about how you evaluate the risk profile of this stock. If the AI and robotics moonshots completely fail, you still own a highly profitable, rapidly growing global energy infrastructure monopoly. If the moonshots succeed, you own the foundational layers of the future of AI and labor, and it was entirely funded by the battery business in the background. It's a massive asymmetric bet.
Which brings us to our final and perhaps most predictive forensic number. This is the indicator that looks forward rather than backward. The fifth number is $4.96 billion in deferred revenue.
Let's unpack the concept of deferred revenue for the listener because it's a dry accounting term that most people glaze over when reading an earnings report. But in this specific context, it is absolutely explosive.
Deferred revenue is essentially a crystal ball into the company's immediate financial future. In strict accounting terms, it represents cash that the company has already collected, or contracts that are absolutely ironclad and guaranteed for massive utility projects that have been sold but are not yet fully installed or switched on.
So they have the money, or the guarantee of the money.
Right. Because the physical product has been completely delivered and commissioned, the rules of accounting dictate they cannot legally recognize it as revenue on today's income statement. It sits parked on the balance sheet as deferred revenue.
So it is essentially a massive pre-funded backlog of guaranteed money.
Yes, and this specific number has more than doubled recently. There is nearly $5 billion sitting on the books, just waiting to be unlocked and recognized as top-line revenue in the coming quarters and years.
Contrast that reality with the unreliability of selling consumer cars. If your primary business is selling sedans to the middle class, you wake up on the first of every month at absolute zero.
It's a tough business.
It's brutal. You have to hope that consumer mood is buoyant, that auto loan interest rates are favorable, that a competitor hasn't just released a cheaper, flashier model. It is a constant, agonizing, month-to-month grind to hit your targets. But here, with the energy division, they have $5 billion of massive, multi-year utility contracts already locked in the vault. It is guaranteed, highly predictable, 30% margin revenue stretching out into the future.
When you connect this to the broader macroeconomic picture, it proves that the global demand for these megapacks is vastly outstripping Tesla's ability to even physically produce them.
Even with the 49% growth.
Despite the fact that they grew production by 49% last year. Massive utility companies and data center operators are literally lining up and putting billions of dollars down in advance just to secure a place in the manufacturing queue.
I have to admit, stepping back and looking at the totality of this data, my entire framework for viewing this company has been completely dismantled. I started this deep dive looking at an 8% drop in car deliveries, nodding along with the mainstream media, thinking the growth story was definitively over.
Which is exactly where they want you to be.
But you have just systematically laid out a 50% growth in physical battery deployments, a 30% profit margin on heavy industry, $4 billion in pure gross profit, a self-funding mechanism for their AI ambitions, and a $5 billion backlog of guaranteed future revenue.
And this brings us to the final verdict on the stock. The fundamental problem, the reason for the massive disconnect in the stock price, is that the market is trapped in an obsolete narrative.
The car narrative.
Yes. They are attempting to analyze a 2026 energy and AI behemoth using a rigid valuation model built entirely around predicting how many metal cars will roll off an assembly line on a Tuesday afternoon in Fremont. It is a fundamental structural mispricing of the underlying asset.
If the old model is completely broken, what is the new playbook? How should we and the listeners who are trying to navigate this landscape be looking at this data going forward?
The new playbook is built on 3 distinct rules. Rule number 1, stop valuing the cars.
Stop valuing the cars.
If you are reading articles, or worse, making investment decisions based on monthly vehicle delivery numbers in Europe, or getting caught up in the emotional, volatile roller coaster of Robotaxi timelines, You are trading on the wrong data sets.
You are missing the forest for the trees.
Exactly. The automotive division, while obviously still a massive generator of cash flow, is transitioning into a Trojan horse. It is merely a physical delivery mechanism for their broader software and battery ecosystem. The cars are the distraction.
So it would be like judging Apple in the year 2010 solely based on their declining iPod sales, while completely ignoring the explosive growth of the iPhone and the high-margin App Store ecosystem. You are obsessively tracking the legacy product instead of recognizing the future engine of the company. That makes perfect sense. What is rule number 2?
Rule number 2 is understanding the AI infrastructure play. We hear endless hype about the AI boom, but the inescapable physical reality is that the world simply does not have enough power generated or stabilized to support it.
It's just a mathematical fact at this point.
The legacy grid cannot handle the thermodynamic load. Tesla is the physical bottleneck for global energy storage. In the California gold rush, the people who consistently made the most money weren't the prospectors digging in the dirt for gold.
It was the merchants.
It was the merchants selling the picks, the shovels, and the denim. Tesla is the ultimate pick and shovel play for the entire global AI revolution. Every single major tech company building $1 billion data center eventually has to knock on Tesla's door to buy grid stabilization.
That is a profoundly powerful way to frame their market position. They aren't trying to build the smartest AI chatbot to compete with everyone else. They are building the toll booth on the highway to the AI future. Every player in the space has to pay the toll. And rule number 3.
Rule number 3 is the oldest rule in forensic accounting. Follow the margins. When a massive company's secondary overlooked division suddenly hits 30% gross margins and quietly bills a $5 billion backlog, the smart money takes immediate notice.
They don't wait for the headlines.
Institutional funds will quietly accumulate shares and build massive positions well before the Wall Street analyst class officially updates its price targets, and long before the mainstream financial media finally changes its doom and gloom tune.
To everyone listening to this deep dive right now, I want you to genuinely evaluate your own information diet. Think critically about the sources you rely on to understand the macroeconomic world. You have a choice. You can either trade on the loud, emotional, panic-driven headlines you see on cable TV, the ones screaming incessantly about an 8% drop in consumer car sales.
Which is noise.
It is noise. Or you can choose to trade on the quiet, forensic, absolutely undeniable math of a 30% margin and a nearly $4 billion cash cow. The math doesn't panic on a red day. The math doesn't care about a delayed software update or a controversial tweet.
The math simply compounds, quietly and relentlessly.
It truly does. So, to summarize my own complete mind shift during this hour, I started off entirely fixated on the declining auto sales. I represented that mainstream surface-level panic.
Which is a very normal place to start.
But by peeling back the layers of these 5 forensic data points, it has become abundantly clear that the core thesis isn't about cars anymore. It hasn't been for a while. It's about the massive, high-margin, utterly necessary reality of building the global power grid infrastructure required to birth the AI age. Tesla stopped being just a car company a long time ago. The broader market just hasn't fully updated its models yet.
That is a perfect synthesis of the data. But before we wrap up this deep dive, I want to leave you, the listener, with one final lingering question to mull over on your own time.
Okay, let's hear it.
We have firmly established today that the world doesn't have enough power for the AI boom. And we have established that Tesla's massive megapacks are the critical physical bottleneck to solve that exact problem.
Right.
But let's take it one level deeper into the physical world. What about the raw commodities required to build these grids in the first place? Think about the elemental materials. We are currently facing a massive, unprecedented global copper shortage, what some macroeconomic analysts are ominously calling the red gold rush.
The red gold rush.
Every single megapack, every single new transformer, every single mile of upgraded high-voltage grid infrastructure requires massive, staggering amounts of copper. If this newly uncovered infrastructure giant is relying entirely on physical raw materials that are rapidly depleting on a global scale, who really holds the ultimate power in the decade to come? Is it the visionary tech company building the battery, or the countries and mining conglomerates controlling the copper in the ground?
Now, that is a terrifying, fascinating, and incredibly complex thought to end on. If you want to build the utopian AI future, you have to dig it out of the dirt first. Thank you for joining us on this deep dive into the hidden mechanics of the market. The future belongs to the owners.